Nice, easy one. What do you think is the main cause of the expectation gap related to going concern in an audit of financial statements? Hands.
This is Rob Desculi. I'll start. Can you hear me?
I can, Rob. You go ahead.
So, I mean, as I answered, I think the biggest issue is the knowledge gap. I think today we still have the issue that the public still thinks an audit is all things to all people. It's not just the financial statements are fairly presented. It should detect fraud. It should see if any account is misstated regardless of materiality. It should identify procedural problems. So I guess with that said, how do we communicate with the public and sort of close that gap? I mean, the others are factors, but I think that's the biggest factor. So how do we sort of teach the public what an audit really does?
That's a great point. So Rob's kicked us off with it being primarily the knowledge gap. Does anybody have any alternative view or agree with Rob and would like to expand?
May I? This is Martijn. I think the knowledge gap indeed is a factor, but suppose all investors today would know exactly what is needed to close the knowledge gap. I don't think that all investors would still be, okay, now we're done. So I think there's whatever the gaps are, if it's evolution or knowledge or whatever, there's there are societal demands on the auditor that are not being fulfilled at the moment. And we can call them evolution. And I think it's good to categorize them, but maybe just as a handy tool, but not being too strict on what category they exactly are.
Mm-hmm.
Can I jump in? Hello?
Yes, please do.
This is YT. You can call me YT. Okay, from Singapore. I'm a professor at the NUS Business School. So I'm described as a corporate governance advocate, kind of in Singapore. So I always write about companies. If there's a scandal, usually the media will ask me for comments, right? So and I every day I'll be looking into companies and so on. So my perspective may be a bit different, but I kind of see the performance gap, you know. So we are kind of, I think there is a knowledge gap that, for example, you know, for ordinary person, user of financial statements who is not trained in auditing, the idea of what is the difference between a material uncertainty relating to going concern versus a qualified adverse or a disclaimer opinion, right? So that can be those kind of, I mean, the investor user may not understand that, but you know, my own sense is that I feel that maybe there's not enough professional skepticism exercise, and that contributes to the performance gap. And while I kind of I understand this whole idea of fraud, whether it has a material effect on the financial statements at the end of the day, right? My own view as somebody who looks very closely at governance is that often what appears to be immaterial or which may not be financial in nature actually could have very serious underlying implications for the financial statements, whether if it's not immediately, in the very near future. Now, let me just give you an example. If I find out somebody has been falsifying their degrees and is senior management or directors, you know, and sometimes I write about them, you know, I kind of would say like, oh, this guy looks like he has bought a degree from somewhere, and he's publicly disclosing it in his in the annual report. To me, that's a big red flag already, you know, because in that case, if the person faked a degree, the likelihood is that the person is going to fake financials. And let's say somebody cheat on expense fraud, right? If it's a junior staff, that's a bit different, right? But if senior management cheat on an expense claim or something, and you discover and you say it doesn't have a material effect on the financial statements, but then the question is, if they cheat on a small claim, wouldn't they be cheating on the financial statement? So I just wonder whether, you know, auditors are sensitive enough to the broader red flags that exist in companies and so on, and that actually alert them to take a closer look, deeper into the financials. Okay, I'll stop here.
Yeah, no, that's fine. You hold that thought because you're already taking us into your points on question 2, which is what more can be done. So hold that thought, and we'll keep that thought. And so just from the conversation so far, I think there seems to be just a general view that all aspects of the expectation gap that I spoke about in the introductory section are there, and people recognise they're there. Is that a fair assessment of what's been said? I've got some nods. Pamela, I think you were going to speak up, or maybe
I don't know if there's a way to electronically raise my hand. I haven't worked it out if there is.
There is, but don't worry, we're doing fine here. No one's interrupting each other.
I'll wave if
yes,
I need to.
Great.
So, what I was going to say is to echo some of what people have said, and to link to your point of, are all the aspects present? I think one could get into quite a debate about the relative weighting of the different aspects. But as we go into the next point about what do we do about it, I think some of that becomes a little bit moot. So I would personally say that I come across quite a lot of misunderstanding about what an auditor's responsibilities are, more to do with fraud than to do with going concern. I think they're different.
Okay.
So I do come across that, and articulating clearly what that is, I think, is an absolute imperative on the industry. But at the same time, in articulating it clearly, you can get to the key question of, is that the right thing? Is what auditors doing the right thing that it should be doing? And then we can move forward the question of, should the requirements change?
So it's more about that sort of steer into evolution. So yes, we can articulate today what it is in a different way, a more transparent way, but actually is that what people want? Is that the right thing? Robin, you have your hand up. I thought if you'd like to jump in before we move on to the second question.
Sure, thanks Josephine. Well, I'm one of these rare beasts that in audit land, because I'm an insolvency practitioner, so I see the downside of audits gone wrong. From my perspective, what I see is that there are so many different reasons why companies fail, and not all of them are financial. And of course, audit deals with financial metrics, and the wider public don't perhaps see that. They look at it and say, well, why couldn't the auditor know that there was something not quite right? And this comes to YT's point, is that inquiring mind of the auditor. I think sometimes whilst professional skepticism is a requirement, I just think that sometimes there is a dearth of that critical mindset, the inquiring mind, because exploring something that's immaterial initially can uncover something that is quite material ultimately. And so I think there's a training issue there. And I think that there is, on the performance area, at times, there is some ethical dilemmas that people perhaps don't turn their mind to as well as what they should. And the old adage is, just because you can do an audit doesn't mean you should do the audit. So we really need to pay attention to those sorts of issues.
That's great. So that's also coming into some of the areas in the question 5. In your view, what can be done to narrow the expectation gap? And some of these little nuggets that you've been talking about, we can pick up again a little bit more there. Just before I get kicked out, perhaps we could kick off with the second question, which is, what should the auditor's responsibilities with regard to fraud in the audit financial statements be? So should auditors all be forensic scientists? They're all smiling at me like, but what do you think? What should our responsibilities, I say are, because I always see myself as an auditor. It's hard to shake it.
I can kick
Please.
off if you like.
Absolutely, absolutely.
Yeah, on fraud, it's. I'd like to give an example of Randstad. It's a Dutch staffing company. They a few years ago reported a fraud of €15,000, €15,000, which by any sense could be considered as immaterial. But as investors, we found this extremely useful information because it highlights to us what the types of fraud the company is prone to. And it gave us a sense of more security than without knowing that the fraud they discovered was €15,000. So we thought of that of highly informative value, actually material in that sense, even though not material in the sense of the materiality criteria. So materiality is not only in an amount, but also in quality. So the qualitative value of information on fraud helps understand the business model and its risks. So we actually propose a zero materiality on fraud. Describe what, and we want companies to describe the types of fraud they are prone to.
Yeah, so from the auditor's perspective, it's rethinking that materiality threshold. Certainly auditors are already required to think about it both quantitatively and qualitatively, but really there should be more thought around the fact that it's fraud, and therefore perhaps there needs to be a different materiality judgment in respect of fraud. Is that, yes, I'm getting nods. That's good. That's good. I'm understanding. Any other thoughts?
I think at the moment, the way it's written, kind of reasonable assurance that there's no, that obviously what is reasonable assurance and what is material, kind of different people have different views. But I wouldn't necessarily say that auditors should be forensic experts. Or I think I read the document. I mean that was the document. They talk about suspicious mind. I won't necessarily say suspicious mind, but I would say that we think about skepticism. I worry sometimes that auditors go in kind of almost having a confirmation bias kind of thing, that they were almost going in confirming that the financial statements, with the view of confirming that the financial statements are free of fraud and material error, rather than kind of be more questioning, because and maybe in different parts of the world it's a little bit different. I would say many the region that I'm in, I wouldn't trust many of the audit committees, that people who sit on audit committees and people who are in management, because maybe the enforcement is not so great in some of these countries in this part of the world. So almost in this part of the world, you almost say, and we have to bear in mind, right, at the end of the day, the financial statements are prepared by management. They want to present the best view possible, right? So you need the audit committees there to be providing that oversight.
Okay,
so I think
it's a little bit of,
yeah.
Sorry, I'll just go. So it's a little bit more understanding around the internal control and the governance structure in there, and also I'm hearing some aspect of greater skepticism, but not necessarily forensic experts.
Yeah.
Sorry, Bob, do you want to jump in?
Yeah, thanks, Josephine. And I've been a little bit quiet. Full disclosure, I'm also an IAASB board member, so very interesting to listen to this. And for a couple of more days, I'll be the AICPA's chief auditor. And then on Thursday this week, I'll become the chief operating officer for RSM International. But a couple of things struck me. This is great. First of all, I'd probably start by saying I kind of agree with this. I'm not sure fraud and going concern are the same animals. I think there's different approaches, perhaps, that need to be looked at. So I'm not sure, how much commonality we can find other than the expectation gap. But the approaches would be different. I just wanted to respond. I do think. Regardless of what the audit standards say, what the auditor's report says, so on and so forth, I think investors and users are intelligent enough to read what the report says about what our responsibilities are. There I go again. I also picture myself as an auditor, what our responsibilities are. However, I think we also need to face the fact that if the public, if the users expect or demand or want more to be done particularly in the area of fraud, then I think, for the audit to remain relevant and be of value, those, the standards need to be responsive, and we need to respond to that. But I do think, Martijn, I get totally, the qualitative aspects of fraud. And from a materiality perspective, but I do think we need to be careful also, and YT kind of brought up the reasonable assurance concept, because when we start talking about, detecting all fraud or looking at immaterial and things like that, we have to understand that carries over. And if you're going to detect even immaterial fraud, that means that you have to test and perform procedures, and that's for every company that you would do an audit for. So it's a very much a desired state, but I think we need to be careful of the practical implications for market forces and competitive and even litigation, tort reform, that sort of thing around the world. So it's I guess all I'm saying is, wow, very complex issue. But I think what I would conclude with is just, if the public and our users expect more of auditors, then I think it's incumbent upon standard setters and auditors to be responsive to that, or the value and usefulness and relevance of an audit will just decline. And I don't think anybody wants to see that.
Yeah, that's a fair point. Robin's got her hand up already, Pamela. So I'm just going to go to Robin first, if I may. So to Martin's point, maybe rethink about those thresholds by which you're examining risks of fraud, but within the context of a reasonable assurance engagement as well, which is the point, Bob, you made before you made the other comments about public and users expecting more. Robin, please go ahead.
Very quickly, just two issues. In relation to fraud, the increasing ability to use technology is, I think, increasing people's expectation that we will find more fraud because we can test, instead of taking a small sample, we can test all. Theoretically, whether we should is a different question. And the other issue is that if you think about from an unsophisticated user's point of view, the whole the audit report sits at the back of the annual report. So the unsophisticated user thinks the auditor is looking at the whole of the annual report. So we need to somehow explain that they're not looking at the whole of the annual report.
Yeah, and that's a really important point for our next breakout as well. So we'll definitely hold on to that point. Pamela, then Martijn.
Thank you very much. Just to reflect on a couple of things, I agree with what Bob was saying. I think going concern and fraud are very different beasts from an expectation gap point of view. So I'll talk about. I
They
think
lost
so.
you.
I've
There you go.
accidentally muted myself. As I think that's what most of this discussion's been on at the moment. There's a couple of interesting thoughts. I think Martin talked about disclosure of material frauds that are not big in number, and how companies are susceptible to frauds and things like that. I think that gets very much into question 5 about the ecosystem and what are management's responsibilities and what disclosures are necessary in different circumstances. The other thing I've heard is about controls and looking at controls and controls testing, and I think that gets very heavily into management's responsibilities to have some controls and to talk about the controls that they have, that they can then be tested. So it links into structures around who's responsible for what. And I realise I'm jumping ahead there, but I think they were sort of important to touch on. But the other thing I think is really important before we get too far in a discussion of how do we deal with fraud is there's not one type of fraud. So if we've got misappropriation of assets type situations and theft, you've got financial reporting manipulation, which is typically topside journal type posting issues. But then you've got fraud that doesn't sit in those categories. So if their company was to give inappropriate representations to a regulator in order to get a stamp of safety, let's say, on their product, it's a breach of a law or regulation, really. So it fits more into laws and regulations type thing, but it's also a fraud because it's intentional misrepresentation. But the responsibilities for anything connected with laws and regulations on auditors are very different to what we're talking about on fraud. And you have to look at them holistically, because I think quite sensibly the person on the street would go, well, that's a fraud, and manipulating the profit numbers are fraud. Don't they all fit together? And auditing standards don't look at them together.
That's all very, very true. Thank you very much. Martin, I'm conscious of time, and we still want to, whilst we've already covered some of 3, 4 and 5, it would be nice to actually have something to mention to the rest of our participants when we go back. So briefly, if you wouldn't mind on this one.
Yeah, thank you. Just seconding Pamela on the last thing she mentioned. It's like companies actually risk their social license to operate if they don't comply with local laws or European laws, whatever. So that's the type of fraud that definitely needs to be covered as well, and it hits big fines as well if you, as a bank. So the second thing is about.
Sorry, just to reply on that, I don't disagree, but the way that the auditing standards are at the moment, they look at them very differently, and I think that needs addressing.
Yeah, and second is that there was suggested that the public needs to know that the auditor only focuses on basically primary on the financial statements. That's indeed addressing the knowledge gap, but the interesting point is that investors rely as much on the narrative as they do on the financial statements. And you can put an awful lot of effort in closing the knowledge gap, but I think there's more effort warranted in closing the evolution gap and evolve to something higher than the consistency check at the moment. And it's really very important for investors that this happens.
So this message has come through a couple of times now, and so just so we have, because we only really get 3 takeaways to debrief, and then we have an open discussion. But I'm hearing that in some extent, and I'm going to be brutal with my words, it's like the knowledge gap at this point doesn't actually really matter, because it's the evolution gap that we need to focus on. Because in dealing with public demands right now, then we also deal with the knowledge gap, and we think about what the future holds for auditors. Now, that's quite a brutal comment, but that seems to be what I'm hearing from when we pop back to these two particular aspects of the expectation gap. I'm getting a few nods. Okay, all right, so that's all fabulous. So why don't we talk about going concern? Because of course, a couple of people have said they're very different. When you're thinking about auditors' responsibilities in relation to even going concern, it's very different to fraud. And I don't disagree with it. So what do you think the auditor's responsibilities with regard to going concern in an audit of financial statements should be? And if you wouldn't mind keeping them brief, because we just don't have enough time, do we? We could talk about this all day. Any takers? Martin, perfect. You can kick us off.
Okay. What we need on going concern is if there's transparency on whether there is or is not going concern. It's as company specific as possible. So no boilerplate stuff at all, because that just clogs up the true information that is there. So what we need as investors is company specific reporting. And possibly if there's something that you definitely want to make a reference to your website, but no clogging of information. Actually, investors don't want companies to report if there's no discontinuity, based on discontinuity, because those accounts usually are useless in practice. So the whole point is not about justifying why it's continuous accounting. The point is highlighting the risks, how close the company is to discontinuity. And if it's, there's so even those companies that fail tend to somehow reorganize and start a new life. And in that case, even in such a case, accounts based on discontinuity are helpless, are just not providing the right information to investors. So just wanted to highlight it's not about, it's really highlighting the risks, how close the company is to discontinuity.
Okay, and so there's that element of, sorry, interrupting. So it's, let's start with what are management's responsibilities and what more could be done in terms of disclosures in the financial statements first, before thinking about what more auditors could do. Martin, do you mind if I let another couple pop in? Thank you. Robin, you had your hand up, and I can see Henry, of course, is burning. Robin.
I think with the issue of going concern and also as with fraud, the whole COVID issue has increased the focus on these, and they are going to be real challenges for auditors in the next few years. For me, I think going concern is for the auditor to ensure that they understand the underlying assumptions made by management, and that they test those, and they test the assumptions as to whether they're reasonable. They test the classification of the liabilities. They check to make sure the assets are realisable, because that really changes the equation significantly if those underlying assumptions are not sound. Thank you.
Thank you, Robin. That's very helpful. Henry?
Thank you very much. Fascinating discussion. I'm on the technical staff at the IAASB, so the going concern obviously there's a real interaction with the accounting requirements. And I mean, maybe it's more relevant to question 5 or indeed question 1, but just thinking about what Martin was saying, we do hear some concerns I think, about the disclosures surrounding the whole going concern basis of preparation in the financial statements. I wondered to what extent that may contribute to the expectation gap, or what views on that were, because I think obviously there are some that think, you know, the absence of any disclosure means it's a guarantee that the company will continue as a going concern. And, you know, to what degree and hopefully hear a little bit this morning so that I can feed back into my organization, but, you know, to what degree do people think that the bar currently might be too high for disclosure, and whether, you know, better insights into the risks, you know, would help around this issue. It's not an area that we're currently working on, but we have an agenda consultation coming up, and so, you know, this will be one of the areas where people will be able to suggest that the IASB itself does some work on. And obviously, if anybody's got any questions about that, I'm, you know, happy to talk to that as well.
I'm happy to immediately react to Henry if you want.
Yes, by all means, Martin.
Yeah, just quickly, the last thing that investors want is that if you improve disclosure requirements, that suddenly all companies start to report some kind of a going concern narrative. That so the whole signaling effect, which is actually quite useful, actually falls apart. So if there are very few or very limited material risks to going concern, the result of the new requirements should be that the company discloses very little about it. So it should, and it shouldn't be that as soon as something mentioned, people already start to think that the company is falling apart. So it's maybe shifting it a bit, but we don't want a whole load of disclosures because of that actually is a detriment of usefulness.
Yes, it's about balance again, Martin. Yeah.
And that was.
Oh, go on. Sorry, Henry.
Sorry, I was only going to say, and you know, when the IASB looked at this about 6 years ago, they were thinking of doing stuff, but they pulled back eventually because they were concerned that it would just lead to a lot of boilerplate information and also the risk of the self-fulfilling prophecy. So it's a really tricky balancing act.
Bob, just given that I want a little bit more time on the last one.
Yep. Very quickly, I'm just interested in the table tennis going on between Henry and Martin here. All I was going to add is I think, you know, one of the fundamental keys that we as auditors or the IAASB need to think about is, you know, what is the auditor's responsibility? Is the auditor's responsibility to opine on the fairness of the disclosures of the financial information, or is the expectation that the auditor is actually opining or concluding or advising users? Where I think that's, you know, that difference between is the information accurate and correct for users to make decisions based upon, or is it something more that is expected where the auditor is expected to also add their thoughts and their conclusions around some of these issues? So that's just, I wanted to add that very quickly, Josephine.
Thanks, Bob. That's great. So just with our very limited time, which is unfortunate, let's roll 4 into 5, because 4 more transparency could also be the answer to 5. So in your view, what may be done to narrow the expectation gap with respect to fraud and going concern? I know a couple of points have already been mentioned, and Natalie's doing a fantastic job at getting those down for me, but any other thoughts as we close our first breakout session? We have about 7 minutes remaining. Yes, Martin, kick us off.
Yeah. It's actually quite a big point for us. I forgot to introduce myself. Martijn Bos, Umedian. We represent 50 institutional investors in the Netherlands. It's about details about the scope of the audit. We read annual reports and that like 80% of the revenues and 75% of the assets were part of the group audit. And sometimes the equity of such company is only 20%. So it could imply that, you know, we are concerned that what is actually not audited, and what does it mean that a certain part of the group was part of group audit, and what does it mean that a certain part of group was not part of the group audit? There are no, as far as I can see, there are no internationally agreed criteria for that. First, there should be clear criteria. And second, I think it's somehow unacceptable that there are recurring parts of the group that remain unaudited. If you, within a certain time frame, and you can call any time frame, but you can say 3 years, 4 years, 5 years, whatever, I would expect that every individual entity of the group has at least once been part of the group audit. And that there's a fraud dimension to this as well. If there's suppose management has a bad intent, where would you try to hide the fraud? Probably in those parts that fall outside the scope of the audit, of the group audit. So I see there a risk, and I think there should be better disclosures, better understanding, and some more strict, uniform criteria for the scope. Yeah.
Okay, Martin, thank you. We will be looking forward to your response to our recently published exposure draft on group audits then, because the intention is always that all is in scope. But of course, we are dealing with reasonable assurance. So, but we'll park that one. Maybe that's another comment we could talk about at another time. And I'm happy to connect with you on that one. Robin, you were next on the list of hands that were raised.
Again, I think it's important to continue to tell the story about the director's role in the and being ultimately responsible for the preparation of the financial information. It's too easy for directors to say, oh, well, the auditors didn't pick it up. The fact is that the first responsibility is with the directors, and I think we need to sing that out loud and clear because the wider public need to hear that. It's not a defence for an auditor. It's just telling the narrative as it should be.
Okay, so greater clarity around who is responsible. And YT first, then Pamela, if we could. We've got literally 4 minutes left, everyone. So as quick as you can, and apologies for such a rush.
I was just going to follow up on Martin's point. Just with a real example, we have a big company in Singapore that 3 months after the year end, after the auditor's report, the financial statements were released. Less than 2 months later, it went into restructuring. So it went into financial trouble. And when you look at this, you have significant subsidiaries which are not audited. So while they say that the group accounts have been audited, I checked that 5 of the 6 Singapore subsidiaries, one was so significant it wasn't audited. So I don't know. So, you speak to auditors, they say they may have relied on management accounts. How can you rely on management accounts when you have such a significant subsidiary? So I don't know whether this is the auditing standards not being clear, or the auditors just didn't do their job. And I think one point I wanted to make too is whether with fair value accounting, with the reliance on impairment and so on, that has also contributed to this growing gap between kind of companies having going concern problems and kind of still having clean opinions. Because this is kind of a case where a huge asset was not impaired, and it turns out that it should have been significantly impaired. So maybe too much discretion, in terms of impairment, too much judgment involved in terms of impairment.
Thank you. Pamela, sorry, we only got a minute and a bit left, but please.
I'll try my 30-second version. So there was a point about management's responsibility and clarity on that as the first point of call, and then to obviously link the auditor's responsibility to that. I wanted to point out that I'm from the UK, and there's various discussions in the UK that actually go beyond the going concern period and think about longer term resilience statements and management statements in relation to those risks, which may or may not be assured separate to the audit and things like that. And I think that's an important part of the broader ecosystem of where does it all go on going concern.
Right, well, thank you so much, everybody.